Welcome back to the Financial Nexus. What we're witnessing in silver markets right now represents more than just another commodity price spike. This is the moment when decades of financial engineering collide with the immutable laws of supply and demand, and the consequences extend far beyond precious metals into the core infrastructure of modern technology and global monetary systems. Silver crossed $90 per ounce for the first time in recorded history this week, obliterating HSBC's technical targets and exposing the mathematical impossibility that has been building in this market for years. But the headline number only tells part of the story. What's happening beneath the surface reveals a systematic breakdown of price discovery mechanisms that have kept silver artificially suppressed while industrial demand has exploded exponentially. The trigger for this historic breakout traces back to a convergence of events that began unfolding in late 2024. Samsung's announcement of their solid-state battery technology created an industrial demand profile that the silver market had never encountered before. Unlike traditional electronics where silver functions as a trace element, these new battery systems require silver as a structural component, fundamentally altering the demand equation in ways that most market analysts completely misunderstood. The mathematics are stark and unavoidable. A single solid-state battery pack for an electric vehicle requires approximately 500 grams of silver. At current production rates, the automotive industry alone will consume more silver annually than total global mine production by 2027. This isn't a forecast or projection. This is engineering reality based on battery chemistry that cannot be substituted or engineered around without compromising safety and performance. Samsung's procurement officers understood this reality long before the financial markets caught on. While silver was trading below $70, Samsung was quietly securing long-term supply contracts with miners, locking in massive quantities at prices that now appear extraordinarily prescient. Tesla, Apple, and other technology manufacturers were simultaneously pursuing similar strategies, creating a hidden bidding war for future silver production that never appeared in spot market pricing. This disconnect between paper markets and physical reality became unsustainable when institutional investors began recognizing the supply constraints. According to 13F filings, hedge funds increased precious metals allocations by 340% in the fourth quarter of 2025. These weren't speculative bets. These were strategic positioning moves by sophisticated investors who had performed the same mathematical calculations as the technology companies. The Venezuelan silver situation added an entirely different dimension to the crisis. 847 tons of silver reserves vanishing from international markets within hours represented more than just a supply shock. It demonstrated how strategic materials can be weaponized through coordinated geopolitical action and how Western industrial supply chains remain vulnerable to sudden resource denial. The timing of the Venezuelan operation was particularly revealing. Infrastructure failures that coincidentally occurred during peak holiday trading periods, when regulatory oversight was minimal and financial journalists were absent. The precision suggests coordination that extends far beyond simple opportunism. When combined with broader patterns of Russian and Chinese strategic metal accumulation, it indicates systematic preparation for resource-based economic warfare. China's position in this dynamic cannot be understated. With over $3 trillion in foreign reserves, China could theoretically purchase the entire annual global silver production for less than 1% of their holdings. The fact that they haven't done so yet suggests strategic patience rather than disinterest. Chinese state entities have been steadily accumulating physical silver, while Western institutions trade paper derivatives that may prove impossible to settle with actual metal. The derivatives market represents perhaps the greatest systemic risk in this equation. According to the Bank for International Settlements, approximately $2.4 trillion in precious metals derivatives are outstanding globally. Even if only a fraction relate to silver, the leverage involved creates massive potential for cascading failures when underlying prices move as dramatically as they have in recent weeks. HSBC's admission that silver above $88 would indicate severe market dysfunction proved prophetic. We are now officially in severe dysfunction territory, and the traditional mechanisms for price suppression through derivative trading have clearly failed. The Chicago Board of Trade's announcement that they're reviewing position limits for silver indicates someone is accumulating positions large enough to threaten market stability. This raises fundamental questions about who has that kind of buying power and what their ultimate objectives might be. Sovereign wealth funds, central banks, and mega corporations represent the only entities capable of moving markets at this scale. The fact that position limits are being reviewed suggests the accumulation is ongoing and accelerating rather than complete. The supply side of the equation offers no relief for these demand pressures. Global silver mine production peaked in 2016 and has been declining consistently since then. New mine development takes 7 to 12 years from discovery to production, and the industry has systematically underinvested due to artificially suppressed prices. Even if mining companies began massive expansion projects tomorrow, new production wouldn't come online until the early 2030s at the earliest. Meanwhile, government mandates for green energy transition guarantee that silver demand will continue growing regardless of price. Solar panel installations, electric vehicle production, and grid storage systems all require silver in quantities that scale with deployment rather than economic optimization. These aren't market-driven demands that respond to price signals. These are regulatory requirements that must be met regardless of cost. The International Energy Agency projects that silver demand from green energy applications will increase 85% by 2030. Electric vehicle silver consumption will triple during the same period. Solar demand will double. The mathematical impossibility becomes clear when these projections are mapped against available supply. There simply isn't enough silver in the world to meet projected industrial demand at any reasonable price. Exchange inventories reflect this structural imbalance. COMEX registered silver inventory has fallen to levels not seen since 2001, while withdrawal rates continue accelerating. At current depletion rates, exchange inventories could be completely exhausted within months rather than years. When futures exchanges cannot deliver the underlying commodity, the entire price discovery mechanism breaks down. The Shanghai Futures Exchange has already experienced significant inventory drawdowns, with 127 tons removed from approved warehouses in a single week. This represents more than total weekly global mine production, indicating that warehouses are being emptied faster than mines can replenish them. The mathematics of this situation are simply unsustainable. What makes this crisis different from previous commodity squeezes is the intersection with broader monetary system instability. Central banks are simultaneously fighting inflation while maintaining massive liquidity injections to prevent financial system collapse. When commodity prices spike this dramatically, it creates impossible policy choices between economic growth and price stability. The Federal Reserve's recent emergency lending without public announcement suggests they recognize the systemic nature of this crisis. Traditional monetary policy tools assume that commodity markets respond to interest rate signals. When industrial demand becomes structurally inelastic, raising rates cannot reduce consumption of materials that are required for basic economic functions. The geopolitical implications extend beyond immediate supply concerns into questions of technological sovereignty and strategic independence. Countries that control silver reserves gain leverage over nations dependent on advanced technology manufacturing. This dynamic is already reshaping international trade relationships and strategic alliances around resource security rather than traditional economic partnerships. The Venezuelan situation demonstrated how resource control can be executed through legally compliant mechanisms that provide no basis for international retaliation. If this model proves successful, it could be replicated across other strategic materials, fundamentally altering the balance of global economic power. For investors and institutions, the implications are profound and immediate. Traditional portfolio allocation models assume that commodities represent a small portion of overall economic value. When critical materials become scarce relative to industrial requirements, their value can dwarf traditional asset classes in ways that existing risk models cannot capture. The transition from speculation to industrial hoarding marks a fundamental shift in market dynamics. When technology companies begin stockpiling silver as a strategic input, rather than purchasing it just in time for production, the available supply for financial trading disappears rapidly. This creates feedback loops where rising prices justify even more aggressive stockpiling behavior. The mathematical certainty of this situation cannot be overstated. Barring revolutionary technological breakthroughs that eliminate silver requirements from critical applications, the structural supply deficit will only worsen as green energy deployment accelerates. The question is no longer whether silver will reach triple digits, but how quickly and through what mechanism. The banking system's response to this crisis reveals the depth of their exposure to failed price suppression strategies. Institutions that sold silver short at lower prices now face unlimited losses as prices move toward levels that threaten their capital adequacy. Emergency Federal Reserve interventions suggest these losses are already threatening systemic stability. What we're witnessing is the early stage of a forced reorganization of industrial supply chains around resource scarcity rather than financial optimization. Companies, countries, and investment strategies that recognize this transition will adapt successfully. Those that continue operating under assumptions of abundant, cheap silver face increasingly severe challenges. The next phase of this crisis will likely involve direct government intervention in silver markets, strategic partnerships between consuming and producing nations, and a gradual recognition that critical materials represent national security assets rather than tradable commodities. The financial markets are beginning to price these possibilities, but the full implications remain underappreciated. The silver market has broken free from decades of artificial constraints, and the resulting price discovery process is revealing the true cost of industrial civilization's dependence on scarce materials. This story is far from over, and understanding these dynamics is crucial for navigating the fundamental shift in resource economics that's reshaping our financial future. Thanks for staying with me through this analysis. The intersection of industrial demand, geopolitical strategy, and monetary system stability continues evolving rapidly, and recognizing these patterns early provides critical advantages in positioning for what's coming next. Make sure to subscribe for continued coverage of these critical developments, and I'll see you in the next breakdown.